The clock is ticking, and the window is closing faster than most people realize. Trump just gave Iran a deadline, 10 to 15 days to make a deal, or face military action. That deadline is about to expire. And in the time since Trump set that clock, oil has exploded from $62 to $72, a 16% rally in less than a week. Silver surged from $78 to $85. Gold broke back above $5,060. And every single piece of military intelligence says the strike is imminent. The United States military is ready. 2 carrier strike groups, 12 warships, B-52 bombers positioned in Qatar, over 100 fighter jets. Everything is in place. The window's open. And the deadline is approaching fast. Stay with me. Because what I am about to show you is not speculation. This is documented military positioning, verified oil market data, and a timeline that ends between now and March 6th. And when that deadline hits, one of 3 things happens. Iran capitulates, Trump extends the deadline, or bombs drop and silver explodes to $100 and $20, maybe $150. Let me show you exactly why. Let me start with what Trump actually said, because the exact words matter. On February 19th, at the Board of Peace meeting, Trump said, "Maybe we are going to make a deal. You are going to be finding out over the next probably 10 days. Later on Air Force One, a reporter asked him to clarify. Trump said, "I would think that would be enough time. 10, 15 days, pretty much maximum." Then on February 20th, he confirmed he is considering a limited military strike to pressure Iran. And he said, "We are either going to get a deal or it is going to be unfortunate for them." That is not vague diplomatic language. That is a countdown. And it started on February 19th, which means the deadline expires between March 1st and March 6th, any day now. Now let me show you what the military is doing, because this is where it gets real. The USS Abraham Lincoln Carrier Strike Group is already in the Arabian Sea. The USS Gerald R. Ford Carrier Strike Group is en route to the eastern Mediterranean. Once both carriers are in position, the strike window opens. And according to a former U.S. ambassador to Israel who spoke to CNBC, everything is in place, or will be imminently, for strikes to commence. Imminently. That means the capability is in place, the window is open. And Trump himself said the timeline is 10 to 15 days, which means any day between now and March 6th, the decision gets made. Here is what else is happening on the military side. Over the past week, the Pentagon has been moving non-essential personnel out of the Middle East, primarily to Europe or back to the United States. According to CBS News, this is standard practice ahead of potential military action. It does not guarantee a strike, but it is what you do when you are preparing for one. Poland's prime minister just urged all Polish citizens to immediately leave Iran. He said, within a dozen, or even a few dozen hours, the possibility of evacuation will be out of the question. Germany moved a mid-2-digit number of non-mission critical personnel out of a base in northern Iraq. Same reason. Preparing for potential Iranian counterattacks. Israel's Prime Minister Benjamin Netanyahu said on February 19th, "We are prepared for any scenario. If Iran attacks Israel, they will experience a response they cannot even imagine." This is not posturing. This is a coordinated military buildup involving the United States, Israel, and NATO allies. 2 carrier strike groups, 12 warships, over 100 fighter jets, B-52 nuclear-capable bombers, positioned at Al Udeid Air Base in Qatar, THAAD and Patriot missile defense batteries across the Gulf, and AWC-135R nuclear detection aircraft. The nuke sniffer, its job is to detect nuclear material in the atmosphere after strikes. When you deploy a nuke sniffer, you are not bluffing. Here's why I think a deal is impossible. And this is the part that should terrify you. In the last 72 hours, 3 things happened that prove neither side is backing down. 1. Poland's prime minister told all Polish citizens to evacuate Iran within hours. Not days, hours. 2. Germany just moved critical personnel out of a base in northern Iraq ahead of expected Iranian counterattacks. 3. Russia and China are conducting live-fire naval exercises with Iran in the Strait of Hormuz right now. Russian warships, Chinese destroyers, Iranian Revolutionary Guard boats, all in the same waters where U.S. strikes would occur. That is not a country preparing to negotiate. That is a country preparing for war, with backup. Russian Foreign Minister Lavrov explicitly warned that any U.S. strike on Iran would have serious consequences. He referenced the June 2025 strikes on Iranian nuclear facilities and said the risks of a nuclear incident are real. That is Russia putting the U.S. on notice. And they are not just talking. China has gone even further. According to defense analysts, China dispatched 16 military cargo planes to Iran in late January. 16, likely providing defensive systems and logistical support. China has been helping Iran rebuild its missile and air defense capabilities after the June war. They signed a trilateral strategic charter with Russia for joint military exercises and intelligence sharing. When I saw that, I realized this is not the same Iran that got hit in June. This Iran has been rearming with help from 2 nuclear powers. This is the CRINC alliance in action. China, Russia, Iran, North Korea, 4 countries aligned against Western interests. And right now, Russia and China are conducting joint naval exercises with Iran in the exact waters where U.S. operations would occur. That is not a symbolic gesture, that is a military tripwire. Now let me show you what the oil market is telling you, because this is where the smart money is positioning right now. On February 17th, oil was trading at $62 per barrel for WTI and $65 for Brent. On February 19th, Vice President Vance went on Fox News and said Iran has not acknowledged Trump's red lines. Markets interpreted that as talks failing. Oil surged 4.6% in a single session. Brent closed at $70.35 per dollar. WTI closed at $65.19. On February 20th, oil jumped another 1.7%. Brent hit 71.76. WTI hit 66.39, both at 6-month highs. In 2 sessions, oil rallied 7%, and it has now gained 18% year to date. That is not normal market volatility. That is a war premium being priced in. Bloomberg Neef published a report in January modeling different Iran scenarios. Here is what they said. If Iran's oil exports are completely removed from the market starting in February, Brent could average $71 per barrel in Q2 2026. If the disruption persists through the rest of the year, Brent could average $91 per barrel in Q4 2026. Now look at where oil is right now. Brent at 71.76. We are already at Bloomberg Neef's Q2 disruption scenario. And the war is not even started yet. This is just the fear premium. Now here is why that matters for silver. Because the connection between oil and silver is direct and mechanical. When oil goes from $62 to $72, energy costs spike. When energy costs spike, inflation accelerates. When inflation accelerates, the Fed cannot cut rates. And when the Fed cannot cut rates, capital flows into hard assets as a hedge against currency debasement. That is why silver went from $78 to $85 in the same window that oil surged. Gold went from $4,997 to $5,062. A 1.3% gain. Silver went from $70 to $85, a 9% gain. Silver is outperforming gold by 7 to 1 right now, and that ratio accelerates when war fears intensify. Because silver is both a safe haven and an industrial metal, gold is just a safe haven. When war disrupts supply chains, when defense contractors need silver for missile guidance systems, when solar panel manufacturers rush to lock up inventory before shipping lanes close, silver demand spikes on both sides. Monetary demand from investors seeking safety, industrial demand from manufacturers securing supply. That dual demand is what makes silver the most explosive trade in a war scenario. Now, let me show you what the first 6 hours look like if strikes begin, because this is what nobody is talking about. Hour 1. News breaks. U.S. strikes Iranian nuclear facilities. Markets are closed. Futures gap and limit up. Oil jumps $15 in pre-market. Silver opens $8 higher at $93. You cannot get filled at $85. That price is gone. Hour 3. COMEX opens. Industrial buyers panic. Defense contractors rush to secure supply. Samsung calls their refiners. Solar manufacturers lock up inventory. Every buyer who was waiting for a dip realizes the dip just ended permanently. Hour 6. Shanghai opens. Chinese buyers see silver at $93 in New York and $90 before the strike. They rush in. The premium widens to $15. COMEX registered inventory starts getting claimed at an accelerated rate. By the end of day 1, 10 million ounces demanded. And the roll process that was barely working, it stops. Because nobody wants to sell contracts when war just started and oil is spiking. That is what the first 6 hours look like. And there is no rewind button. You are either positioned before hour 1, or you are chasing at $93 wishing you bought at $85. Here's the math. If oil goes to $91, that is a 26% increase from current levels. Historically, silver moves 3 to 5 times more than oil during geopolitical crises because of its industrial demand component. If oil moves 26%, silver could move 78% to 130%. That would put silver at $150 to $195. Now, I am not predicting that happens. I'm showing you the math that institutions are using to model scenarios right now, and those institutions are positioning accordingly. That is why silver surged 9% while the military buildup accelerated. Now let me show you the timeline that connects all of this. Trump's deadline, 10 to 15 days from February 19th. Expires March 1st to March 6th. The window is closing, military ready, imminent. Strike capability in place. China reopens from Lunar New Year, February 24th. Asian buying resumes. March COMEX first notice day, February 27th. Just days away. Supreme Court tariff decision, already ruled. Tariffs struck down, but being replaced through other mechanisms. Now think about what happens if strikes begin before the deadline expires. Oil is already at $72. If the Strait of Hormuz gets disrupted even temporarily, Bloomberg NEF says oil hits $91 by Q4. That is a 26% spike from current levels. And the Strait of Hormuz handles 20% of global oil supply. If Iran threatens to close it, which they have said they will do if war breaks out, oil does not go to $91 gradually. It gaps there overnight. Silver at $85 would look cheap. Because if oil spikes to $91, inflation expectations explode. And inflation expectations are what drive precious metals more than anything else. Gold went from $4,400 to $5,726 in January on war fears alone. That was a $1,026 move in 1 month. And that was just fear. Actual war is a completely different magnitude. Now let me address what happens if Iran makes a deal, because intellectual honesty matters. Could Iran capitulate and make a deal? Sure. And if that happens, the war premium comes out and we consolidate. But after watching the buildup for 3 weeks, I'm not betting on that outcome. And neither is the oil market at $72. Here's what happened to silver during the last Iran war. Because history is the best guide we have. In June 2025, the US and Israel conducted Operation Midnight Hammer. They struck 3 Iranian nuclear facilities. Gold spiked above $4,000. Silver ran hard. Oil surged. And the move happened overnight. There was no time to position after the news broke. You were either already in or you missed it. That was a limited strike. 3 facilities, surgical, in and out. The operation Trump is considering now is reportedly broader. According to Axios, any potential U.S. military action could extend for weeks and be significantly more expansive than June. If June pushed gold to $4,000, what does a weeks-long campaign do to gold at $5,060? And what does it do to silver at $85, with COMEX inventory at 98 million ounces and March deliveries standing at 98%? This is why the timing matters so much, because March 1st notice day is February 27th, just days away. If war breaks out before March 27th, physical silver demand accelerates on top of an already stressed delivery system. Industrial buyers who are planning to wait rush to secure supply. Defense contractors lock up inventory. Solar manufacturers prepay for metal. And COMEX, which has 98 million ounces of registered silver against 240 million ounces of open interest, faces delivery demand it cannot satisfy. War does not create the silver shortage. When the shortage already exists, war makes it unsurvivable. Now, let me show you what the market is actually pricing in right now. Prediction markets show a 61% probability of a U.S. strike on Iran by March 31st, with over $322 million in volume traded on that outcome. That is not retail speculation. That is institutional capital betting real money on real probabilities. Oil has a $7 to $10 war risk premium already built in. That is the difference between where oil would be trading on fundamentals alone and where it is trading with Iran tensions. If the probability of war is 61%, a $10 risk premium seems low. Because if war actually breaks out, the premium is not $10. It is $30 to $50 per barrel, which means either the market thinks the probability is lower than 61%, or the market is underpricing the risk. I think it is the second one, because the military buildup is too large to be a bluff. You do not deploy B-52 bombers, you do not move 2 carrier strike groups, you do not evacuate non-essential personnel, and you do not set a public 10 to 15 day deadline unless you are prepared to follow through. Now let me show you what smart money is doing, because this is where you see the real positioning. Energy stocks are surging. ExxonMobil is up 25% year to date. Chevron is up 22%. The Energy Select Sector SPDR fund is up 21%. Gold mining stocks are holding strong despite gold pulling back from 5,726 to 5,062s. Silver mining stocks are outperforming. And institutional call volume on gold and silver has spiked. Someone accumulated 11,000 call contracts on gold, with strikes at $15,000 to $20,000 expiring in December. That is a bet that gold triples from here by year end, and it was added aggressively even as gold pulled back. Smart money is not selling the dip. Smart money is positioning for the scenario where Trump's deadline expires with no deal. And when that happens, the move will not be gradual. It will gap. Oil to $80, then $90, then potentially higher if the Strait of Hormuz is disrupted. Gold to $6,000, then $7,000. Silver to $100, then $120, then potentially $150 if industrial demand surges on supply chain fears. I'm not predicting those exact numbers, I'm telling you what the math looks like if war breaks out and oil spikes 30% to 50%, because precious metals always move in multiples of oil during war. That is the historical pattern, and the pattern is reliable. Now let me give you the three outcomes, because this is what you need to understand. When Trump's deadline expires between March 1st and March 6th, one of three things happens. Outcome 1. Iran capitulates, halts uranium enrichment, agrees to Trump's terms, war premium evaporates, oil falls to $62, silver retraces to $78, gold pulls back to $4,900, temporary correction in precious metals. But the structural drivers remain intact. COMEX inventory still draining, supply deficit still widening, government price floor still being built. This outcome is possible, but I think it is unlikely, because Iran has shown no willingness to accept Trump's preconditions. Outcome 2, Trump extends the deadline, gives Iran more time to negotiate. Oil consolidates at $70 to $72. Silver holds $80 to $85. Gold holds $5,000 to $500. No major move either direction. But the tension remains. The military stays in position, and the war premium stays in the market. This outcome kicks the can down the road, but it does not resolve anything. Outcome 3. The deadline expires with no deal. Strikes begin, oil spikes to $80 to $90 within days. Silver runs to $100 to $120. Gold breaks $6,000. COMEX faces a delivery crisis as industrial buyers rush to secure supply. Physical premiums widen. Shanghai premium expands. This is the outcome that changes everything. And based on the military positioning, the diplomatic breakdown, and the 61% probability in prediction markets, this is the most likely scenario. Now, let me talk directly to you about what this means for your positioning. If you already hold physical silver, do not panic sell on any short-term dip. The structural case has never been stronger. What you are holding is insurance against exactly the kind of event we are watching unfold right now. Whether strikes happen this weekend or before March 6th, physical metal in your hands is the one asset that no court ruling, no exchange intervention, and no supply chain disruption can take from you. If you are thinking about buying, understand that timing the exact bottom is nearly impossible during a crisis. What matters is being positioned before the next leg up. And the next leg up could be triggered by a single headline. A strike on Iran, a Strait of Hormuz closure threat, a COMEX delivery failure. Any one of these moves prices 10% to 20% in hours, not days. Hours. Waiting for the perfect entry means watching the move from the sidelines. And if you hold paper silver or gold, futures contracts or ETFs, understand what January 30th showed you. When prices move too fast in one direction, the system crashes them to protect the shorts. They raised margins 50% on December 26th and December 30th. And when silver hit $121, they let it fall to $78 in one session. Paper positions are vulnerable to exactly that kind of intervention. Physical is not. So where does that leave us? Let me give you my read. We are inside Trump's 10 to 15 day countdown. The military is ready. The oil market is pricing in a war premium. Silver is outperforming gold 7 to 1. And before March 6th, Trump makes a decision. Deal or strikes? One or the other. If it is a deal, the war premium comes out, silver retraces. But the structural bull market remains intact. If it is strikes, oil spikes. Silver runs. Gold breaks $6,000. And COMEX faces the delivery crisis I have been warning about for weeks. I think strikes are more likely than a deal, not because I want war, but because the buildup is too massive to be theater, and because Iran has shown zero willingness to accept Trump's terms. But either way, the days ahead are the most consequential for precious metals in years, because when the deadline expires, the uncertainty resolves, and the market reprices accordingly. You cannot undeploy 2 aircraft carriers, you cannot unposition B-52 bombers in Qatar, and you cannot put 98 million ounces of silver back into a COMEX vault that is draining at 20 million per month, while industrial buyers bypass the exchange entirely. The things that are in motion right now cannot be undone with a press conference or a last-minute deal. They can only be resolved with either a capitulation from Iran that looks politically impossible, or strikes that change the price of everything. The clock is ticking, the military is ready, the oil market is screaming, and Trump's deadline is days away. When that deadline expires, one of two things happens. Iran surrenders their nuclear program and humiliates themselves in front of the entire Middle East. Or bombs drop. And when bombs drop, silver does not ask for permission to move. It does not wait for you to be ready. It does not care if you were planning to buy next week. It gaps from $85 to $105 before you finish your morning coffee. From $105 to $130 before COMEX opens. From $130 to $150 before the weekends. And the people who bought at $85 will be selling to the people who waited at $150. That is not a prediction. That is what happened in June 2025 when gold spiked $400 in 72 hours on a limited strike. And June was 3 facilities. This is the full campaign. If you want to see what happens when 2 carrier groups, 100 fighter jets, and a 10-day deadline collide with 98 million ounces of COMEX silver and 240 million ounces of claims, subscribe. Because when the bombs drop, I will be here showing you the vault data in real time. The oil price, the Shanghai premium. In the exact moment COMEX realizes it cannot deliver during a war. This is not hype. This is math. This is physics. This is a countdown. And it ends the moment Trump gives the order. Verify every piece of data I showed you. The military reports are public. The oil prices are live. The Bloomberg Neff scenarios are documented. The ones who check primary sources do not need me to tell them what is coming. They already see it. Stay sharp.